You would have heard about CEOs opting in for $1 salaries, right?
Google, Oracle, Capital One, Hewlett Packard, Kinder Morgan, Duke Energy, Fossil, and Urban
all have
Outfitters
CEOs with a salary of
a dollar or less. The key word
Do you know why they do that? They do that to avoid taxes and instead switch their compensation to something like getting stocks. And instead of choosing to pay taxes on their salaries, they choose to pay taxes on their capital gains.
I was never in this for the money, but it turns out that the money was an absolute necessity.
Yes, it is that big, and they have figured out how to leverage this capital gains tax for their benefit. But let's come back to our level. Capital gains tax is something everyone has to pay, but how much to pay? That depends on.
And so one of the ways we're going to tackle that is by increasing the capital gains tax.
There's 5 federal tax increases that are coming in 2023.
Capital gains tax is so simple to understand yet very complicated depending on your situation. If I sell my stocks or my home or any stuffs for higher than the original price, then technically I have to pay the tax to the government. Capital gains tax is more like volunteer tax. That means it depends on the taxpayer and not the government on when to actually pay that tax. Let me help you understand how. If my capital gains rate is high, I might decide to hold off on my assets and not sell them right now. So it totally depends on me when I want to sell my assets. And only when I sell my assets, I have to pay the tax. So now you understand how the capital gains is structured. Let's understand how it's calculated. The capital gains tax rate is different for different countries. Here I'm showing you all the countries where the capital gains tax rate is observed. I'm also putting down the link in the description of this article so you can see what the tax rate is for your country. But for Canada, the capital gains tax rate is calculated on half of your profit after all the necessary charges. And you will also have to make sure that all your investments are held for at least 1 year and 1 day. Because if it's less than 1 year, then it is not called your investment, but it is called your business and you will have to pay the tax on the entire amount. In terms of calculation, let's say if I bought a stock for $100 and the stock value rises up to $150 and I paid commission of $10, 5 for buying and 5 for selling, that means my overall profit is $140. No, it's just $40. And so my overall capital gain is $40 on my investment. Now, if I held this stock for more than 1 year and then I'm selling this stock and I'm making $40 on it, then technically I have to pay taxes on half of it, which is $20. And the taxes are calculated based on my tax bracket. So I have to pay taxes on that $20 depending on what tax bracket I am in right now. Hi, my name is Raj and my goal is to bring financial literacy to the people in the world. So I'm trying my best to come up with the easiest explanation on the most commonly misunderstood topics in the finance and investing world. If you are interested to learn more from me, please consider subscribing. So let's continue. Now that you understand how it is calculated, let's try to understand the most important thing in this case, which is unrealized capital gains and realized capital gains. The unrealized capital gains is something where your asset is performing good and you are making profit out of it, but you haven't sold them yet. So technically you are gaining something from your asset, but you haven't sold them to realize the profit. And in that case, you do not have to pay the taxes until you realize those profit, meaning you sell those assets. Unless
Joe Biden wants to tax unrealized capital gains. That is, if you own stock and it rises in value, the Biden administration wants to tax you even though you haven't sold it.
Now we don't know if that's going to happen or not, or if that's going to happen with Canada or not, but let's think it is not happening for now. And you remember I told you the most important thing in this case, which is unrealized capital gains and realized capital gains. You might be thinking, I have made a lot of money in the stock market, or probably I have made money in the appreciation of the house, which is not my primary residence, and probably I should sell them and use that money to diversify my investment, or probably use that for something I want to purchase. But wait, not so soon. You have to pay the capital gains tax on it, which could come anywhere between $20,000 to $25,000 on your $100,000 investment. So technically, whenever you are withdrawing or whenever you are selling your assets, make sure that that also involves paying capital gains tax. So it is important for you. Every time you sell anything, you are obligated to pay tax. And worst part is if you're doing before 1 year, then you'll have to pay full tax on your profits. No 50% discount. So you have to make sure that you have that money which you can keep aside for paying the taxes at the end of the year. Don't forget that. But you might be thinking, oh, it's voluntary. What if I don't report it, right? Maybe not in this case. Because if you are selling your stocks, your broker will report it. If you are selling your house, someone else will report it who is basically purchasing your house. And if you are selling any other stuff, let's say a Gucci bag for a profit, then probably your buyer will report it if they are purchasing it as an investment. So there is no way to hide from paying taxes. But there is a way to reduce the capital gains tax. And if you are doing any of these things, watch the video here where I'm explaining to you how to reduce your capital gains tax on these investments. So thank you for watching, and I will see you in the next one.